If a certain billionaire tried to write one single check for his entire net worth, that check would bounce. Not because the money isn't real, because it doesn't exist in the form a check needs it to exist in. This sounds impossible. Somebody worth over $200 billion can't cover a check. But once you understand why, you'll understand exactly how the wealthiest people on Earth actually operate, and it has almost nothing to do with the number you see in headlines. Start with the number itself. When you hear that someone is worth $200 billion, that number is not sitting in a bank account. It's an estimate, calculated by multiplying the number of shares someone owns in a company by whatever that stock's current price happens to be. It's a valuation, not a balance. And a valuation can evaporate faster than it appeared. That's node 1, and it already breaks most people's assumption. Net worth is not cash. It's paper value tied to a number that moves every single day the market is open. So why not just sell some shares and get real cash? This is where it gets interesting, because for someone holding a massive stake in one company, selling is almost never a clean option. First, selling shares triggers capital gains tax immediately, often at rates approaching 20% or more depending on jurisdiction, and on gains that can run into the billions, that tax bill alone can hit the billions too. Second, when you own a large enough percentage of a company, selling a big block of shares doesn't just get you cash quietly, it signals the market. Other investors see the founder selling and start asking why, and that panic can tank the stock price before you even finish selling, which means you get less money for the shares you do sell, and every share you still hold is now worth less too. Third, and this is the one people rarely think about, selling shares means selling ownership and often selling voting control. For a founder who built a company specifically to run it a certain way, giving up shares can mean giving up the ability to make the decisions that built the fortune in the first place. So selling is expensive, it's public, and it can cost you control. That's node 2, and it's why the wealthy don't do it if they can avoid it. Which brings us to node 3, and this is the actual mechanism, the one that explains everything. It's sometimes called buy, borrow, die, and once you see it, you can't unsee it in how the ultra-wealthy actually live. Step 1 is buy. You acquire an asset that appreciates, most commonly company stock, though it works with real estate and other assets too. You don't sell it. You just hold it, and on paper, your net worth climbs. Step 2 is borrow. Instead of selling shares to get cash, you use those shares as collateral for a loan from a bank. Banks are happy to do this for large stockholders, often at interest rates lower than what a small business owner could ever get, because the collateral is enormous and liquid on paper. Here's the part that matters most. A loan is not income. You can borrow hundreds of millions of dollars against your stock and pay no income tax on it, because legally, it isn't income. It's debt. You spend that borrowed cash on anything you want, homes, businesses, whatever, completely tax-free, while your original shares stay right where they are, untouched, still growing. Step 3 is die, and this is the part that closes the loop entirely. When someone passes away, the assets they hold get what's called a stepped-up basis. That means for tax purposes, the asset's value resets to what it's worth on the day they died, not what they originally paid for it. All the capital gains that built up over decades, gains that would have triggered a massive tax bill if sold during their lifetime, simply disappear for tax purposes. Heirs can then sell the asset near that new value and pay little to no capital gains tax on the growth that happened during the person's entire life. Buy an asset. Borrow against it tax-free instead of selling. Let it pass to your heirs at death with the gains erased. That's the full loop, and it's completely legal, built directly into how tax law treats loans versus income versus inherited assets. This is why a person can be worth $200 billion on paper and genuinely not have that amount in spendable cash sitting anywhere. The wealth is real. It's just structured to never need to become cash in the first place. Here's the reframe. This isn't a secret trick hidden from the public. It's tax and legal architecture that's been publicly known for years, built around assets most people simply never own at the scale required to use it. Understanding the mechanism doesn't require access to billions. It requires understanding that wealth and liquidity are two completely different things, and the people who actually keep their fortunes intact for decades know exactly which one to hold on to. If this shifted how you think about what a net worth number actually means, this is exactly the kind of mechanism we break down every week, how money actually moves at the top, not the version sold to you in a headline. subscribe, because next time we're covering the exact legal structures families use to pass this kind of wealth down for generations without losing half of it to estate tax.